tried to argue with me the child tax credit went up.
Yeah.
So clearly it's going to help the middle class. And then I had to explain to them about the dependency exemptions.
Yeah.
And how it didn't.
No, it's the child tax credit, not necessarily. So, all right, so let's take a look at what credits we have and how they're going to help us or not. All right, so the big picture talks mainly about education in this example. So this example just talks about the fact that they have two dependents in college. Laura's a freshman. It talks about her tuition totaling $14,000 and the fact that she has some scholarships and how much they paid for her tuition outside of that and how much of that then they also paid for room and board. And then Sam's a junior, and they paid $8,100 plus another $7,200 for room and board. And then they give you their AGI of $158,000. And then they say what is available to them. Well, just a little bit on, and I've mentioned this the whole semester, so hopefully you understand this, how a tax credit is better than a tax deduction. All right. This gives you just a little example of someone that's in the 25%, well, they give you three different examples, sorry. If you take a 25% credit compared to a deduction at various marginal tax rates. So if we have a $1,000 expenditure and a tax benefit of 25% credit, if the 25% credit is allowed and you're in the 0% tax, marginal tax rate, you would get no deduction, but you'd get a $250 tax credit. If you're in the 15% tax rate, you'd still get a $250 tax credit, but you'd only get a $150 tax deduction. The only way that the tax deduction is better is if you're in the 35% tax rate. So in this example, the tax credit is better for everybody except for the higher tax rate. All right. So for the most part, it is always better. Now, the thing that doesn't take into consideration in that is phase-out limits. All right, and we'll talk about some of those phase-out limits. The other thing that we're going to talk about is refundable versus non-refundable. Okay, refundable credits are so much better because they come after your tax liability. So you can have zero tax liability and still get a credit if it's refundable. Earned income credit is a refundable tax credit. And that's the reason it being is that earned income credit is for low-income families, typically families. You can get it without having children, but it's a low-income credit. Therefore, a lot of times there is no tax liability. But earned income credit can actually give you back money even if you have no tax liability. It's a refundable credit. All right? Non-refundable credits can only be used to offset a tax liability. So, for example, if I owe some taxes and I'm getting a credit, child tax credit, it can reduce how much tax liability I have before they figure out how much I actually owe. So the credit can be used to offset my tax liability. If the credit exceeds it, I lose it. Usually the higher income you go, the more tax liability you have. Now here's a list of some. These are also in your book. Notice the only two non-refundable are refundable, said them the wrong way, are earned income credit and taxes withheld on wages. However, there are part of child dependent and educational tax credits that are refundable. So there are portions of that that can be refundable. And how much depends on your income. So there isn't a flat amount that they can say. But the only two that you can say are taxes withheld on wages, so that basically whatever you pay in deducts from what you owe, and earned income credit. Those are the only two. So now we're going to go through all the different credits. Some of them are credits you're going to see on a regular basis, and for whatever reason, as we go through this list, they're going to be the ones we talk about last. All right. So the first one is general business credit. All right. The general business credit is composed of several different business credits, kind of combined into one. It limited to your net income of either greater of the tentative minimum tax or 25% of the regular tax. All right, it cannot exceed 25%. You can carry this tax back 1 year or carry it forward 20 years. So this is something you can actually go back. Now, what are you going to have to do if you're carrying it back a year? You have to amend. So it is something you're going to have to figure out. But that's just a general business tax credit. Then you have your rehabilitation expenditure credit. This is for a substantial rebuild or rehabilitation of certified historic structures. So prior to this year, prior to the new tax laws, a 10% credit was allowed for non-historic buildings. This has now been replaced by the 20%, but it does have to be certified historic. So it's bigger, but it has to be certified that it's a historic building. The credit is taken over a 5-year period, starting with the year that you're starting to put the rehabilitation into place. All right. You have a question on this one?
Yeah.
What?
So I think the
Which
rehab
credit
was
line?
to help,
Not low income. There's a different credit for that. Okay. This is, rehabilitation is for only certified historic places. To qualify, the building must need substantial rehabilitation, though. All right. So you have to, it has to exceed the greater of either the adjusted basis or $5,000. So that cracks me up that it says substantial, but then it says or $5,000. To me, $5,000. Exactly. Okay, the qualified rehabilitation expenditures do not include the cost of the building or related to enlarge it. All right, it's just what currently exists. Then we got the work opportunity credit. This applies to the first 12-month worth of wages paid to individuals who fall in a targeted group. That targeted group includes high-risk youth, felons, food stamp recipients, targeting a group of individuals that a lot of times people do not want to hire. So if you're willing to take a chance on individuals that a lot of times people don't want to hire, or it doesn't even have to be, high risk is sometimes a term, it could be summer youth employees. A lot of times people don't want to hire summer youth because what do you have to do at the end of the summer? You have to hire people again, right, and training is always a pain in the butt. So they get a percentage of the first $6,000 of wages for eligible employees. 40% has, if the employee has completed at least 400 hours of service to the employee. 25% if it's less than that. So if they're part-time and they're not working as much, you get less of a credit. Right.
Is that why they ask you if you're any of that, like on applications?
When they figure that out, yeah. Yep. All right. Yeah. Research is divided into 3 parts and probably is the most detailed here in trying to figure out how to apply the credit. From my aspect with regards to what we're looking at, the details are not very important from our class. Obviously, from the CPA exam, there could be more details involved from that standpoint. It is divided into 3 parts. You have what's called the incremental research activities credit. You have the basic research, and you have the energy research. Okay, the incremental research is the credit equals 20% of the activities minus the base amount. So the qualified expenditures minus whatever that base amount is. You get 20% of that detail. Qualified expenditures relates to discovery of technology information intended for use in new or improved business components. All right, so you're basically trying to improve whatever business, but it has to be new or improved. Expenditures qualify fully if your research is done in-house, but if you use an outside firm, only 65% qualify. So they really want you to be doing the work themselves. Tax is treated as research and R&E expenditures, full credit, but you have to reduce your expenses. So if you're going to take the credit, you have to reduce your expenses on your Schedule C. If you take full expense deduction and reduce the credit, then you can take 100% of the credit times the maximum corporate rate. And then full credit and capitalize the research expenses, you can amortize it over 60 months. So the very first one, that is the biggest one to try to figure out what you're doing. That's the incremental. The basic research credit, you get an additional 20% is allowed on basic research payments in excess of the base amount. Basic research payment minus the base amount in cash to be qualified as a research organization. So is your company a research organization such as a college or university? Basic research is any origination and investigation for the advancement of scientific knowledge, right? Not having any commercial objective. So if you think of colleges and universities, it's not a commercial objective, right? It's for the advancement of scientific knowledge. So therefore, you can have a credit of 25%. And then the energy research credit is pretty straightforward. It's to stimulate additional energy research, and it's 20% of the amounts paid or incurred to the taxpayer. So that one's pretty straightforward. Low-income housing credit. This credit is nationwide, and it's a nationwide allocation of the credit. The credit amount is based on qualified basis of the property, which is dependent on the number of units that you rent. All right, so the number of units rented to low-income housing, the credit's allowed over a 10-year period. All right, and when it says it's subject to recapture, that means that you could have to go back, and any amount that's taken could have to be taken back. Those could be for various reasons. All right, so subject to recapture could mean that you could have to go back in the event that you are no longer renting as a low-income housing. All right, disabled access credit. So for businesses that were placed in service before 1990, so now we're looking at 28, almost 9 years, well, 28 years because it's November 6th. There is a credit that you can get for removing barriers. All right, I think about this a lot actually when I think about the different places that we've gone to that I'm like, there is no way that this building is handicap accessible. And the credit is 50% times expenditures that exceed $250, but a maximum of a $5,000 credit. So they give you an example. If it's $10,250, the credit's actually $5,000, 50%. Obviously, the reason behind doing this is all places have to be ADA compliant, so they're giving you a credit in order to help you do that. All places are still not ADA compliant. But when I say all places have to be, that's not true. All places that it's certain levels of, I can't even remember what it is, but so many people capacity or open to the public.
Like the dollar stores, they have like the accessible sign on there, but the door is still has to be pulled open.
Right. There's different things of how things are enforced and at what level they have to be enforced. But most businesses have to be ADA compliant. All right, there are credits for small employers that have a pension startup. Obviously here, that is to help small businesses offer pension plans, because obviously if you have a small business offer pension plans, that's a stimulant for small businesses to employ people. So it's less than 100 people who earn at least $5,000 in compensation. So therefore, they're making sure that you actually have the right amount of compensation under the right amount of people. You're not just offering pension plans to people that aren't making any money. The credit is 50% of the startup fees. All right, the limit is a $500 credit per year for 3 years. So it's not huge, but it is a credit. All right, this one is a credit for employee-provided childcare. Not a lot of places have this. The college used to have it, all right? All 3 campuses used to have childcare, and it became more expensive to offer the childcare and they weren't charging very much. But one of the problems with the childcare, even though I'm still against the fact that we got rid of it, was that it was a drop-in type thing. So you always had to have enough people on staff to have for kids, but you never knew how many kids you were going to have. And I can't remember what they charged. I could be completely off base, but like when I started, it was like $2 an hour. So it was something that a student could afford. If they were coming here for a night class for 3 hours, it was $6. So they could afford to do that. But you can imagine to run the building and to have X amount of people over there, in case they had 20 kids, they had to have so many people on staff. The only daycare we still have is at Flow Valley, and that's because that's where they also run the child development classes, so they have that. That is one thing they have talked about adding back, and I don't know all
Maybe make people
where.
say if they're coming to class or not.
There's got to be a better way to do it.
Because
Let's-
if you needed a
Sign
babysitter,
up thing, just be
There's
like,
got to be,
call them, right?
there's got to be a better way to do it. I don't know what the answer is, but there's got to be a better way to do it.
maybe that's the plan.
At a lower amount, again, so that, because I do believe we lost students, especially the non-traditional 24 to 40-year-old students we lost when we lost childcare at all three campuses. But Wildwood doesn't have as many non-traditional students. Here, Monsanto and Ralston are two companies I know have childcare. There are others, those are just two that I know. So they can offer credit for providing childcare facilities on the facility during normal working hours. It's limited to $150,000 a year. The credit is 25% of the childcare expenses, 10% of the qualified childcare resources and referral services. So this is a big help to them, but then in addition, having a childcare on site is a big pull from a standpoint. I was one of the things I liked about Ralston when I looked at going there was that they had the childcare on site.
Or less like the parents call out, be like, my babysitter didn't show up.
Yeah.
Well, that's
And you
good.
get to go have
Show
lunch.
up to work.
Now the disadvantage is when you're not working and you want to take your kid to childcare, you got to drive down to work, take your kid to childcare. Credit for childcare, a deductible qualifying expense must be reduced by the credit. What they mean is all the other expenses that you incur in the childcare, you have to deduct by that credit. So if they incur $500,000 of expenses, they have to reduce it by the $150,000. All right. Basis of the qualifying property must also be reduced. So wherever they have the facility has to be reduced, and the credit may be captured to recapture if they cease within 10 years of being placed in service. All right, credit for employee-provided family medical leave. All right, this is a nice one too. Employees can claim a general business credit. This is from the beginning. Remember the general business credit I said was a combination of a lot of different. So that this is one of them, equal to 12.5% of the wages paid to employees who take the Family Medical Leave Act. All right, so if you're not familiar, everybody familiar with the Family Medical Leave Act? Which basically says you can take off up to 12 weeks and your employer really can't say no. But it's unpaid. Right? Everybody can take up to 12 weeks off for family emergencies, but it has to be unpaid. Your employer cannot say no if it's unpaid. What they're giving you a credit here is if the employer pays you a minimum of 50% of your wages during that time, they can receive a credit equal to your 12.5% of the wages. It's increased by 0.25% for every percentage point that they pay you above 50%. So they're encouraging you as a company to pay people. An example of paying is paternal leave. All right? Every man is allowed to take Family Leave Act for a period of time after a newborn is born. Newborn is born. So if they pay them during that time, they could potentially get a credit for that pay. Right? My husband didn't get paternal leave, but I'm not even sure paternal leave was paternal leave when my kids were born. The employer must have a written policy in place that allows all qualifying full-time employees no less than 2 weeks of annual paid family medical leave. So they have to state it. All right? The credit applies to wages paid in taxable years beginning 2017 to 2020. So it's relatively new that they're offering this credit. Earned income credit. So we'll talk and then I'll show you something. So general qualifications must have earned income. All right? From an employee or self-employed. That's hence the name. And I know that's for 3 of you sitting here. Sounds kind of simple. But you'd be surprised how many people come in and don't understand the concept of earned income credit. That means you have to have a job of some sort in order to get this credit. Right? It does not mean you can have interest. It does not mean you can have dividends. It's not for trust fund babies, which most time trust fund babies don't ask for this. It does not for Social Security. Okay, if you're living off Social Security, does not count. Social Security is not earned income. It has to be for working. This is for someone who is working, huh?
Disability.
Disability does not count unless it's disability for wages lost. Okay, if you're getting disability because because you're hurt and not working, then it does count, all right? But if you're getting disability because you're not working, then that, because of other reasons, then no, all right? So earned income credit is meant for low income where you're not making enough of a wage, where they're helping to supplement by a credit you're getting at the end of the year. Almost all the time, it's with the addition of a kid. So you can see the maximum earned income, one child is $3,461, two is $5,700, and three or more is $6,431. So it can be a substantial credit, but the pay, I think the next one shows you, yes. All right, so the applicable percentage is multiplied by the amount of money you make, the percentage I just showed you. It phases out when you earn more than $24,000. That's two people making more than $24,000 with a qualifying child. All right, so let me show you, and I did not print on there. I'm going to pull it up. Oh, wait a minute, hang on. Nope, okay. So take a look. Hang on. So what we're looking at here, this is just the form. It's focusing, there we go. That you would fill out if you had a child or some more than one child that would go along with the earned income form. And I'm going to try to, I'm not sure why I didn't print the other earned income form.
So like
So-
when someone claims someone's child.
Yes, if you claimed as child, you'd fill out the name, social security number, the birth year, how old the child was, and what the relationship for the child was with you. And that has to be filled out for every child. If you have more than 3 kids, then you're going to fill this out more than one time. And I'm pulling up. Here we go. Okay, so the earned income credit tax brackets. This is just your tax brackets. I don't like when it prints like this, but hang on. Personal exemption, earned income credit. All right, we know that. That's not what I wanted to find. I wanted to see, I should have just brought it in from VITA from last year. There it is. Okay. So here are, so if you're single and you have no kids, you cannot make more than $15,000. If you have children, it can go up to as much as, within a household, $49,000. It can go up to as much as that. Depends on how many kids you have. If you're married filing jointly with no children, you cannot make more than $20,000. It could go up to as much as $54,000. Now let's see what happens if it makes me happy when I click this, or if it's going to take me into something that's a mess. Yeah. See, that's usually why I just left it at the, oh, there we go. That's not too bad. Okay. So, single with no kids, you cannot make more than $8,470. $90. One kid, 18, 2 kids, 18, 3 kids. So if you're single, you cannot make more than $660. If you're single, had a household, complete phase out, is here. So it's slightly different, but that is a little bit, that's the low and that's the high, and there's other reasons for those numbers. Here we got married filing jointly. There is a slight phase out going up with this as well. Notice down here they kind of have what the credits are, which is those are the numbers that are in your books. So you're looking at very low numbers. And there was someone that I helped do their taxes, and going back to this wonderful form right here, she was a VITA person 2 years ago. And she had low income. It was under $8,000. She had no kids. So she qualified for earned income credit. One of the things you're going to see on the next slide is the fact that very few people qualify for earned income credit without kids. It just doesn't happen very often. She did. The IRS, the people looking, I shouldn't say the IRS, whoever was reviewing her taxes, just did not get that she did not have to submit this form. So they sent it back saying she did not complete the earned income credit EIC. And we returned it and said she did not have to. And so they sent it back again saying she did not complete the EIC. So I sent it back in saying she did not have to, but here's a blank one. She has no kids. She qualified without kids. It took 6 months for them to figure it out and give her her money. Well, the people that are answering the phone calls haven't possibly even been through a tax class, except for the IRS tax class. The people reviewing the tax returns, I can't even tell you what their qualifications are. They're not CPAs.
Yeah, but you would think after being told,
You would think, but you'd be
at least look at it a little.
They messed up my dad's taxes, and it took me writing 3 letters. And I highlighted stuff. I mean, I'm pretty specific. Refer to page 3, letter G. And it was because they taxed my mom's pension. State pensions for teachers are not taxable in Missouri. It wasn't a very hard thing to figure out. Huh? That was one that got you. You're correct, but I don't know what the other one is.
Oh, it was the housing one.
Oh. So you'd be surprised. Once they find a mistake, and here's the other thing, just because you send it back in, it could be a completely different person doing it. So they send you a correspondence letter. You answer the correspondence letter by saying, I don't agree with you. Here's why. It goes back. It doesn't have to go back to the same person. So now somebody else is looking at it.
But you would still think somebody gets a letter that says, I don't have to do
You know, here's one time I am agreeing with you, Kiki. I just don't have the right answer for you. I can tell you they don't figure it out. But I also wouldn't work and do what they do. So, all right. So the credit, like we talked about, the IRS tables will give you the exact amounts we just looked at. 25 to 64 to get the earned income credit. All right, who cannot be claimed as a dependent if you do not have children. The reason being, why do you think you cannot have to be over the age of 25 without kids, and under the age of 64 without kids?
If you're less than 24, you can be claimed as a dependent still.
You can be claimed as a dependent, and if you choose not to be claimed as a dependent, first of all, it's your call, right? Second of all, they're not expecting you to make a lot of money. So that's not supposed to. Now, if you have kids, different story. But if you don't, that's not who this is meant for. If you're over the age of 64,
Security doesn't count as earned income.
Social Security, exactly. So that's not who it's meant for either. All right. The credit for a married company filing jointly with no kids is 7.6% of earned income up to $67.80. All right. The credit is phased out once earned income exceeds $14,170. So again, not meant for individuals with no kids. I mean, I shouldn't say that. Not many people without kids get this credit. All right, we have a credit for elderly and disabled taxpayers. All right, this is for those over 65 and those under 65 who are permanently or totally disabled. Due to these AGI thresholds, again, not a lot of people get this. The credit is equal to $1,125. It's reduced for taxpayers who have Social Security benefits or their AGI is in excess of amount of the thresholds. Yes.
And this is separate from the increase in the standard deduction.
Yes. This is a credit. The increase in the standard deduction is going to be up above. Credits are all below. And I'll pull up the 1040 when we're done. But they're all below what you're below the line. Exactly. All right, adoption expense. You can get a credit for adoption expense. It is a small dent, but it's a nice dent that you can help get. It's $13,810. Pretty sure this went up a little bit. I think it was $13,500 prior year. It goes towards adoption fees, court costs, attorney fees. It is phased out somewhere, $207,140 and $247,140. Don't ask me where they come up with these numbers, but that's where it's phased out. So it is meant to try to help afford. If you have never seen or helped with someone with an adoption, this $13,000, $30,000 for an adoption is completely normal. So this is kind of a drop in the bucket. The child has to be under the age of 18 or physically or mentally impaired or not able to take care of themselves. It's a non-refundable credit. However, it can be carried forward. So therefore, it is helpful to individuals who can't take it all. They can keep carrying this carried forward. This is one credit where, notice it does say you have to file married, filing jointly. You cannot file separately for this credit. It's not the only one. It's the first one that says it. All right, dependent and child tax credit. This one's new because it's not just a child tax credit. It's now also called a dependent tax credit, meaning I actually can deduct my son who's in college, not to deduct. I actually get a $500 credit for my son who's in college. This credit used to just be for anyone under the age of 17. All right? Or under the age of 17, okay, for a child tax credit. Under the age of 17, you get $2,000. It was $1,000. Now it's $2,000. So they doubled that. The other thing they did, you're going to see on the next slide, they increased the phase out drastically. All right? So a lot more people are going to get that. So this is one of those credits where a lot of people were talking, saying, this is one of the positive things that the new tax law changes. They've doubled the credit and increase the phase out. And that is absolutely true. That is true. That is what they did. They doubled the credit. So if you have 3 kids, you're now getting $6,000 instead of $3,000. And they doubled the phase out. So if you used to get phased out of it, you're back in. Right. In addition, this year I would not have gotten my son. I now get $500 for him. I didn't before.
How old is he?
He's 18. But he's in college, so he's a dependent. So you get $500 for basically college kids, all right, or high school kids, because I didn't get him when he was in high school. So now it is phased out as AGI exceeds 400,000. It used to phase out around 130,000. So that's a drastic change, all right. It is a partially refundable credit. So on lower income levels, you can get up to $1,400. But no more than 15% of the credit in excess of the $2,500. So that's only for the children. Yeah, the child tax part, not the dependent. Dependent tax credit is not refundable, so that's only basically if you have a tax liability. But so the 2 good parts of this: number 1, it doubled. Well, 3 good parts. It doubled. There is a dependent tax. So also, I said your college or high school at 17, 18. If you have a parent that you're claiming as a dependent, you get $500 for your parent. Right? So any dependent that's over the age of 17 and over, you get a $500. And they more than doubled the phase out. So a ton of people are now included in this that were not included. What people did not include in this conversation, all of them that were talking about this, because some of my brother's friends were like, but they did this. They did not talk at all about the exemptions going away. So yes, you got $2,000 per kid, but you lost $4,000 per exemption. Now this is a credit, and that is an exemption. So there is a difference, right? We said from the beginning, An exemption reduces your tax liability, and a credit is a direct reduction of what you owe. So let's use my brother as an example. There are 6 of them. That is a $24,000 exemption loss. So he just gained $24,000 of taxable income, correct? But he also gained, I had to multiply 4 times 2. He also gained $8,000 of a credit. So is having to pay tax on $24,000 worse than getting a $8,000 credit? It depends on your tax bracket, absolutely. I don't know what his tax bracket is. So let's just say that his tax bracket is 28% because that's our capital gains tax bracket, right? So we're going to go with that. If his tax bracket is 28%, and I said it was $24,000 that he gained, right? The tax on that is $67.20.
So he only owes $2,000 more than he would have.
So he owes $67.20, but he's getting $8,000 credit.
No, I didn't have.
So he's actually gaining
2,000.
less than $2,000. He's gaining about $1,300. But if he's in a higher tax bracket, so let's jump it after 28, 30, let's just go to 30. $24,000 times 30, he's at 72. But if he jumps all the way to 36, he's losing money. So could it be a wash? Could be a wash for him. Right?
As long as you're like a lower income, like I know some they're single mom
Right.
in school, they might not be as hurt as that.
They might not be as hurt. Now that's just exemptions per child tax credit. They might be okay. That's not taking into account any other changes. But the other change that is really a wild card is the fact that the taxes have decreased. And we won't know the changes of those. And that's what I just been telling everybody. It's a wild card what these taxes are going to do. I really believe if you're single, you're probably going to be okay. And you're probably going to benefit. If you're married, single and not itemizing. If you're married and not itemizing, you're with no kids, you're probably going to benefit too. And not itemizing. But with kids, and if you've previously itemized, it's kind of up in the air. Could be good, could be bad, could be exactly the same. I mean, honestly, it just depends on how many kids, how much you itemize, what are your taxes, like real estate taxes versus other things. It's just going to depend on how those things fall into place. And I think everyone's going to be different. The example we just had, I mean, that's a different way of looking at it with my brother. I mean, I thought his exemptions were going to kill him, but yes, he has 4 kids. So those 4 kids at $2,000 each versus, you know,
But
the
if
credit.
He had like 1 child, he'd be.
But he had 1 child, but then he would only be losing 3 exemptions. But $2,000 isn't going to save 3 exemptions, exactly. So, and the phase out going up is huge. And that's one of the things they talked about.
One last question.
I doubt that. Just
One
saying.
last question on this one.
Okay.
Next credit, we don't know. When I was invited, it seemed like most of the time, if they were completely and totally disabled, they really were treated about the equivalent
Of a child, but not for the child tax credit.
Not for this.
No.
It would only be $500.
Yes. Yep.
That's what I.
Now, dependent care, yes, you can have dependent care for someone who is totally disabled, if it allows you to work. That is something that sometimes people don't understand. You do not get to pay for child care for you to go to the gym, okay? Dependent care, we've had people come into VITA who are paying for dependent care and only one person works, all right? You have to have 2 people working to have dependent care. Now, if one person is in school, you can count that because it is like working. Exactly, that doesn't get included. So you have to have employment costs for someone under the age of 13 or someone who is disabled. All right? If you're over the age of 13, you are considered to be able to take care of yourself. Yeah. So basically they're saying the age of 13 is 8th grade. My son's 13, and he is in 7th grade. And so, and he does stay by himself during the day. So, I mean, that's something else you have to think about, but he does. He stays by himself. And so, would you want to do that for 9 hours every day? Probably not. But I think they're thinking they're in school most of the time, too. What are you going to say?
But if you're a nurse, maybe goes to the ER, and so it's overnight, then you could probably argue, well, I couldn't leave my kid home.
You can't argue that. There's no arguing the qualifications of whether or not you can claim dependent care. If your kid is over, if it's 13 or over, you do not get dependent care. It kicks it out. It says no. So no, you don't get to. That's a gray area then that unfortunately you fall into the thing where you don't get it. And you have to rely on family members for help if that's where you fall. Yeah. My mother-in-law raised my husband as a single mom. And it just fell where it fell. You know, sometimes you couldn't afford this, so then you fall where you fall, even if you could deduct it, you know. So you do have to file a joint return for this credit as well, all right. This one is one where you have to use the tax form. So I'm going to show you the tax form in just a second, all right. The cost of a qualified individual, it can be in the home or it can be outside the home. The dependent or the spouse must spend at least 8 hours a day within the taxpayer's home, meaning your kid has to be with you, all right? The amount of the cost has to be less. It could be $3,000 for one kid or $6,000 for 2 or more. So, in the event of my brother, all right, he had 4, their maximum deduction would have been $6,000. Okay, she stopped working once they had number 3. But that would have been their maximum deduction. Now, at some point, when you have 4, at least one of them is in school, okay?
Oh,
You hope.
could have had them back to back.
They were pretty darn close, but one was in school. But yeah, you could have 4 under the age of 5. I mean, you definitely could. You can deduct after school care, all right? And then if you have a child that is disabled or needs special schooling, we talked about that before too, that is a medical expense. There are some limitations. The eligible cost cannot exceed the lower cost of what somebody is making. So if someone is working, let's use a nurse, okay? But let's say they're not a nurse, they're a tech, I don't know, I'm picking, not even a tech, something, right, lower end, and they're working 16 hours a week, but very weird 16 hours, right? So they're making a very low end scale. You can't be paying to have them in a daycare that's, you know, elegant child for 6 hours a day to hit those times, and you're paying, you know, $16,000 a year or something. So, all right. Full-time students or disabled taxpayers or spouses are deemed to have earned income up to a maximum per month limit. So there are limits. So let me show you, because I believe in your homework this comes into play. This, I'm going to shrink it in a second. This is the 2441. This is your dependent care form. A lot of the forms you don't need in order to do a homework problem. You either need this form or you need to find where it's at in your book, I'm pretty sure, to do a homework problem. Here you list your kids. You have to tell them who you're paying it to. All right? Even, I didn't use a daycare. I used a day person, okay? I used a babysitter. I was lucky enough between my job and my husband's, we only had 2, at the most 3 days a week that our kids went. And I usually didn't work the summers. I wasn't teaching at the time that they were little, but I usually didn't work much in the summer. So we had very odd, so we just used a babysitter in her home. So down here, actually wrong way, up here, it said her name and her social. Because if I was deducting it, they were going to make sure she was including it. All right, so for those people that are not official and not doing it correctly, if your babysitter does not include it in their income, you can't deduct it on your taxes. Right? There are people that do that. That is not correct, because the person that's not including it in their income is not abiding by the law of including all income in their taxes. Right? And actually, someone who does babysitting in their house gets a lot of deductions. A lot. They get to deduct all the food, square footage of their home, just a whole bunch of expenses. So the number that you're going to need is down here. So based on your income will determine the amount of the percent that you get of a deduction. or credit, sorry, credit. So depending on what your income level is, you're going to end up getting, the lower the income, 35%, the higher the income, the lowest you're going to get is 20% of the amount of your expenses. But remember, you're capped. $3,000 per kid, $6,000. So sometimes it can be a pretty quick mathematical. You're spending 20 grand for numerous kids going into daycare. You can take what that is, multiply by 0.2 and be like, yep, 6. You know, still got to do the form, but you can kind of know what it is. So that at 2441 is the number of that form. Most of the time you don't have to do the back of this form, but the back of the form is from box 10 on your W-2. You can have dependent care benefits taken out of your paycheck. That is the best way to do it because that's completely tax-free. That means if you are paying $10,000, you can have up to $5,000 taken out of your paycheck. That means $5,000 is tax-free. Then the rest you can do on this form, but that $5,000 will be reported on the back, so they know you already had $5,000 taken out. Okay. The last couple here are what will interest you guys, and unfortunately, these do have some tax income limitations eventually, but they're targeted at they're higher tax limitations. But so we got 2 education credits. The American Opportunity, which used to be known as the Hope, that's eventually going to go away because most people don't even remember the Hope. And then the Lifetime. The Lifetime, the thing you want to remember about that is you guys can always take that. If you're not taking it now, you will probably take it at some point, and you can always take that. As long as you're taking classes to better yourself, you can take the Lifetime credit. Right? Both credits are for tuition and related expenses. Both include books and other course materials. American includes books and other course materials. Both do not include room and board. All right, room and board is out. And if you've paid for anyone to go to a school with room and board, they always separate it. So it's not like it's hard to tell how much is room and board. Maximum credit for American Opportunity is $2,500. That's for the first 4 years of your post-secondary. It's pretty easy to calculate. It's 100% of the first 2,000 and 25% of the next. That's how you come up with 2,500. The Lifetime credit is 20% of the first $10,000. So when you all go on to get your master's, so you can sit for your CPA exam or whatever you decide to do, it's 20% of that master's. And so that's what I took when I got my master's. And most master's programs, if you're taking it at any amount of courses at one time, you're going to have that. So you're going to get the 20%. You cannot claim both credits in the same year. One credit at a time. The one thing that I have noticed with most people with American Opportunity is they don't want to take it right away. Okay? But if you notice, it's the first 4 years of your post-secondary education. Meaning, it's the first 4 years you go to school. It's not the first 4 years that you want to take the credit. It's the first 4 years that you go to school. Now, some people didn't take it the first 4 years. So, if you're going to school and you have not yet taken the American Opportunity Credit, you can take it. But if you already have your bachelor's degree, you can't then say, well, I didn't take it. I'm going to take it now and get another. It doesn't work like that. All right? If you've gone to school for 4 years, you don't get to take the American Opportunity Credit. If you've gone to school for 2, then you get to take 2 more years of it. All right? So it just depends on how you've gone to school.
Is it worth it to amend for that?
Is it what?
Is it worth it to amend your taxes for that?
A lot of times, yes. Depends on how much you spent. I mean, it's 100% of the first $2,000. That's a credit. I mean, that's usually you're getting it back, yeah.
Because most people go to those 4 years for independence.
Right, so it depends on who's claiming it. If you're claiming it for yourself, yes. All right. So, okay, next slide. You, yourself, all your dependents, to be eligible for the American Opportunity, you do have to be in school at least 50%, which half a year. However, one thing to keep in mind for half a year is one semester, 5 months out of the year. All right? So if you go to school one academic term full load, you are a full-time student. It's a little different. Most people think full-time means you have to go for, it's one semester. All right, so phase-out limits. American Opportunity starts phasing out at 80. All right? Beginning when, and then it phases complete, I'm sorry, 100 and, did I just say that wrong? No. 80, 160 when you're married filing jointly. All right? The credit's completely phased out at 180 for a married filing jointly. Lifetime is lower. Lifetime is 114 married filing jointly and phases out completely at 134. So much lower for lifetime than it is for American Opportunity. In addition, 40% of the American Opportunity is refundable. So once you figure out that credit, up to 40% of it is refundable. So if we go back to the big picture, the Snyders make $158,000. Their kids wanted to know how much of it was of their tuition and everything. Keep in mind, what do we know about the room and board for Laura and Sam? Nothing on either one, right? So of that tuition amount, 100% of the first $2,000, 25% of the next. So for both of them, they're going to get the maximum amount. You can tell just by looking at their dollar amounts, you really didn't even have to do the math. They get 100% of the first $2,000, 25% of the next $2,000. They're well over $4,000 in tuition, so they're getting $5,000 total credit. Now, it's a nice credit on their tax return. Are they going to be phased out? They're under, well, look here. They're just under it, aren't they? So that's almost worth not getting a, no, just kidding. Depends on what that extra bonus is. So, well, it's phased out, so they're not losing the whole thing at 160 or 161. All right, now assume that their AGI is 172. No, 180. 180. So they're eligible to claim a $2,000 credit. Basically, they figured it out for us. They're eligible to claim a $2,000, all right? So they went through and they figured it out for us. They had a $60,000 reduction. See how they did that? 172 minus 160 divided by 20. They tell you how to do that, which is a 60% reduction. So they take their total amount and they can get 40% of it. So they're just showing you how you come up with that reduction. Luckily for all of us, that will be done for us on a computer, but that's how you would do that if you had to do that by hand. Lifetime learning credit, assuming their AGI was smaller, they could qualify for tuition and fees of $4,000 because it's 20% up to $10,000. They're over that for both kids. Their modified adjusted gross income is below the 160. All right. So all their qualifying expenses, they take the 4,000 times 20%. It has to be reduced because their AGI is too high. So they walk through again to try to figure that out. What, Tom? One per taxpayer, not per house.
One kid taking the whole, and the other kid
Yes,
taking
absolutely. So in this example here, both kids are getting the American Opportunity, so the 5,000, and then this example is Tom is qualifying for the lifetime. And Tom can qualify. He has a potential of getting $800. He had $4,000 worth of expenses at 20%, which is the lifetime credit, so it's $800. However, their income exceeds the 114 by $14,000. They changed their income again for you guys. So that's phased out. So we have to take and figure out by the range. So they do that same formula that they did on the page before. So they can only get 30% of that $800, which is $240. So the $240 gets added on to the $5,000, and they get $5,240. So actually, everybody in the house could get a credit, but only the kids can get the American Opportunity. Unless mom never went to college. If mom never went to college and decided to go to college, she could get the American Opportunity. Only for the bachelor's, first full year. So for example, my husband has his associates. If he were to go to school and get his bachelor's, he could get year 3 and 4. Now, he never took the American Opportunity for 1 and 2, but he took what was then called the HOPE for year 1 and 2. So he took a credit for it. All right, there are a few retirement plans out there that you can get a credit for. You have to be at least 18 years old, and you cannot be a dependent on somebody else. These are usually to encourage low and middle class people to put money into retirement. So a lot of times this is when you are putting money into retirement, but you actually aren't making very much money. And sometimes it will just show up, like if you're doing a tax return, even with a program, and you'll be like, you can see them putting money in, but their income is real low, but they're being smart and putting money in, you'll see a little credit pop up and you'll be like, you got a credit for this. All right? Or you can ask them, are you putting money in? And if they're putting money in on their own, they can still get this credit. So it doesn't have to be a work retirement plan. Maximum credit is $1,000, but that is actually a lot looking at the income levels that they're talking about. All right, the last couple things we're going to talk about is just payment procedures. They're not hard. I just want to make sure that you guys are aware of them. Hopefully you're aware that not only you and I pay FICA, Medicare and Social Security, but your employer is paying that as well. So every time you and I pay 6.2% of our salary, our employer is matching that. So that someday, 12.4% of our salary is sitting there, right? Right. And Medicare is 1.45, and they're paying 1.45 as well. Does anybody know what the max is for Social Security right now? Meaning, you pay 6.2% up to what?
Big number. You gotta be like a doctor or dentist.
Okay, a doctor and dentist is making a lot more than this number, just so you know.
So like 70?
No, it's a lot more than that.
It's like 200,000.
It's not that. It's not that big. It should be.
100.
100. We're playing the prices right. All right. The other thing before I change the slide is employers pay that, but they also pay our unemployment taxes, especially in the state of Missouri. Missouri does not make their employees pay it. Some states you do, but in the state of Missouri, we do not pay our unemployment. 128.4. Amy and I were just talking about this because my mom and dad talk about back before they had us that there used to be a time midsummer-ish, my dad's an electrical engineer, where there would be called cap day. And that would be where people with a good job, educated job, would hit the Social Security cap. And I can't remember exactly, it was like $4,600. All right, now my mom was a teacher in public schools. She did not make that. But my dad did. And everybody that had this good educated job outside of teaching and things like that would celebrate because they hit cap day, meaning they no longer had to pay into Social Security. And this was a known day, like because people would, and this is sometime between June and like September, depending on how much money you made, but people would hit it. The average American does not hit that number. Now, people hit it, don't get me wrong. Educated people hit it. But I can tell you, I'm not sure my dad would hit this if he was still working. Right? And so, but yet he hit it before he had kids doing what he did. But yet I'm not sure he would hit it at 60 or 65. So Social Security has gone up, which it had to, right? Because the reason it keeps increasing is because it has to make sure it can pay the people in it, right? So the question that has been posed, not by me, by people, is if the normal person, you and I, never stop paying, why do we have a cap? Why doesn't, because the people that make above that stop paying. But it's not the average everyday person. So it's only those well and above.
They
Now-
stop paying like,
They stop paying any Social Security. Once they make 128,401, they don't pay tax, Social Security on that one.
if they make that in a year.
If they make that in a year.
Right?
They don't pay. So like, whether
They don't pay
it's,
Social Security at all.
no, they paid on the first 128,400.
Right, but once they make that.
Then, let's say they make 130,000.
Right.
1,600 does not pay Social Security. The rest of that, they pay Social Security on.
But we pay year after year.
Year after year, they start over again. So somebody like,
New job.
if they start a new job, if they've already paid for that year 128,400, they will not pay at the new job either, though they usually screw that up.
It takes it out.
Then they have to get it back, yes. So somebody like Albert Pujols
All of
pays
them.
128,400.
And that's probably like the first half of the first.
That's a game, maybe. But now here's the other side of this. Social Security, when you do get it, is, once you hit a certain level, the same for everybody. My mother-in-law made drastically less than my dad. I'm sure. I don't know what my dad's top pay was, okay, but I know my mother-in-law's. And she is getting the same Social Security almost that my dad gets. Now, she took hers early. That's why I say almost. She took it at the age of 65, not 67. So if someone making, and I'm making these numbers up, 50,000 is getting the same Social Security as someone that made 90,000, and Albert Pujols making whatever in the heck he makes is going to get the same Social Security, then there is a reason to cap it, right? Why should Albert pay in at billions of dollars, but should the cap only be 128?
I think the cap would be at whatever, so that you're coming in as much as.
That's exactly right, and that's what Amy and I were talking about. The cap, we thought, used to be at whatever got you what you were going to get back. Here's the problem. That won't fund it. That's what I think the problem is. If we put the cap at whatever it is to get me, because it's now, there's more people, there's not enough people paying into it to fund the people taking out of it. And it's being used for more than what it was originally being funded for. People on disability, not originally funded for. Children whose parents pass away, not originally funded for. Now, all positive, good things. Those are not negative things, but not originally funded. Funded originally to assist with retirement.
So what's the
Assist.
2 extra things, like if somebody?
Well, that's only 2 that I know of.
Oh.
But
What was the first one?
disability.
And then if somebody, like.
And
a
your
child
children. A child
parents.
passes away, you get your parents' Social Security until they reach 18. But if your parent
What
had,
happens to the extra money? It's just-
exactly. And then you got someone like Jim's cousin on his dad's side, grandmother is turning 109. She's killing Social Security.
She's living a lot longer.
You're supposed to pass away like 72. Jim's grandpa died at 102. His grandma died at 93. My grandma died at 93. The average age is supposed to be like 72. So anyone living past 72 is hurting it, but anyone that passes away before 72 helps it. However, if you die before 72, you didn't pay into it until retirement age. Right? So I'm just throwing all these things out here. I don't have the magical answer, and I can't tell you what the cap should be. I'm just telling you
Maybe like $1 million.
that might even be high, to be honest with you. I'm just not sure.
500,000.
I'm just not sure 128.4 should be it. I know when I started teaching 11 years ago, it was 92. So it's gone up $40,000.
Probably should go up more.
Now, is it going to be funded? Can it stay funded? All those are great questions. And you know what's interesting to me? It depends who you ask what the answers are. So,
I don't have Social Security.
well, they told me not to plan it, and they told 10 years ahead of me not to plan on it. But the people 10 years ahead of me should have it. So just don't plan on it, and you should be okay.
Should be a nice little surprise if
Yeah.
you do.
Most of this you should know. You fill out a W-4, you get a W-2, hopefully. Estimated payments, that you should see that in your final tax project. A taxpayer who owes at least $1,000 has to make estimated payments. A lot of people don't understand that. We're a pay-as-you-go society, meaning you pay as you go. You don't wait and pay once a year. So if you owe more than $1,000, you're supposed to make estimated payments. In order to avoid penalty, if you don't make estimated payments, you need to pay 90% of what you owe this year, kind of hard to guess that, or 100% of last year.
For most people, as long as they fill out their W-2, 34,
They're fine.
it should be.
Where you run into problems is a sole proprietorship or someone that does a job on the side as a sole proprietorship. Yeah.
There is a new form for if you have multiple jobs.
Yes.
To recalculate your potential.
Right, because when you have multiple jobs, each job looks at it as if they are your only job. Therefore, they tax you as if they're your only job, so they think you don't make very much money and they don't take enough taxes up. Yeah, when you have like 3 or 4 W-2s, you get hit because nobody takes out enough taxes. Yeah. Yeah. And so, exception, if you increase your pay to 110% of last year's AGI, that will always help. There's your estimated payment due dates. That was not what I wanted to do. I don't know what I just did. Yeah. There we go. I hit something funky. Okay. Estimated. Not up there, it's not. No, there we go. Okay. There's your estimated payment due dates. Self-employment. You must realize that anybody with more than $400 of pay has to pay their own Social Security and Medicare. You do that when you do a Schedule C. So you should take care of yourself. And then you get half of that back. I love this slide the most. This is the only slide about the Affordable Care Act. It just says it was enacted to help individuals take shared responsibility payment. There's a premium tax credit, employer share, and insurance credit for employers. I can't answer any questions about it because supposedly this is going away, but yet there was a commercial on the radio today about the fact that you needed to get registered for Obamacare. Time was running out. I didn't even know you could still register for. I don't.
It's like open enrollment.
It's open enrollment, but I thought that Obamacare was going away. So, but yet I know it's not replaced by anything. So obviously it's not going away.
I thought they were just doing it as a penalty, but they were keeping the
Yeah.
Right, and that's what that's my guess
They're
now.
keeping it,
Yeah.
but not
No
charging
penalty.
a fee.
And
Right.
they're not, the changes are for 2018, it's for 2019 that they're looking at now, correct?
Right. Well, they don't have anything to put in place. Right. They wanted to get rid of it, but they don't have they can't agree on what to replace it with. And then also, last thing is there's a high income tax. Individuals have an additional Medicare tax on wages and unearned income. This is because everybody gets Medicare, no matter of your wages. Everybody pays it, everybody gets it. Doesn't mean everybody takes it. I would imagine those that make a lot of money have their own private health insurance, that they probably don't take Medicare, but everybody can take Medicare. I'm not sure how some of those private health insurances work. I don't know if they take Medicare first and then they just have their private health insurance supplement it, or what they do. But on the high income, they have to pay another 0.9% on wages received in excess. And those excess amounts are over $250,000 for those filing jointly. If it's separate, it's $125,000. It also applies to those that are filing self-employment. And then Medicare tax is also imposed on estates and those that have investment income. But that's pretty specific for, no, not just rich. $250,000 for married filing jointly can be 2 people in very good jobs. So that's not rich. That's just upper middle class. So, well.